Hello, and welcome to this discussion from Aubrey Capital Management on global emerging markets.
My name is Rob Brewis, and this is John Ewart, and we're two co-managers of the Aubrey Global Emerging Market Strategy.
I'd like to begin this discussion by highlighting the graphic which demonstrates the returns recorded by the MSCI Emerging Market Index and other indices within the MSCI category, notably the consumer staples, consumer discretionary, but importantly, the Aubrey Gem Fund returns itself. The MSCI index has returned a modest 20% since March 2012, which is the date of the inception of our fund. By contrast, the Aubrey Fund has delivered over 135% for our clients. Importantly, over 80% of that alpha has been generated by stock selection, finding good companies at attractive valuations which generate positive returns for investors. We continue to think that the opportunity for emerging market investors is attractive, but it has to be at a country, a sector, and a company level, rather than looking at all elements of the index. China and India have been particularly successful areas of investment for us over the period of the fund's tenure. And with 1.4 billion people in each country, we continue to expect that to remain the case. As people get wealthier, they spend their money, and there are many products, services, and e-commerce opportunities that have developed in China and certainly will be developing in India over the coming years. Now, investors watching this discussion will be well aware that some countries, such as China, have been on the receiving end of a fair degree of criticism this year. But tell me, Rob, do you think that this has been overdone?
Yeah, I think China's been in the headlines for all the wrong reasons, and it's been a very difficult few years, particularly with COVID lockdowns and so on. But I think we have to be realistic and realise that China's glory years of growth are well behind it. But we still think there are opportunities. And this chart shows the one of those, which is a company called Brewis Cosmetics, and the black line is the share price chart. And you can see that even in what has been a pretty tough bear market in China, Brewis has made you reasonable returns over the last 5 years or so. Interestingly, the green line is the PE of that company, and you can see that has been heavily derated during this period. And I think that reflects a lot of the companies that we still own in China that offer good value. But if what we would like to say, though, is don't write China off just yet. There are areas in China where the world really can't do without and are doing extremely well. Electric vehicles, batteries, solar panels, etc., all things that we couldn't really do without and are growing very, very quickly. As you can see from this chart, China has overtaken all the other major auto exporters in a period of about 2 years. A pretty dramatic move. So I think there still remain opportunities. But that said, we are more excited about the potential in the next decade or so about India.
This is an interesting slide because it does highlight the extent of the improvement which the people of India are seeing under the reign of Prime Minister Modi, who was first elected in 2014. The investment in infrastructure projects such as national highways, the rail network, and also the port capacity has been greater in the last 10 years than it has been since the country gained independence. But it hasn't only been at the infrastructure level. Many of the country's citizens are seeing a significant improvement in their daily lives through investment in facilities such as sanitation to their homes, utility services to their homes, and also the affordability of homes, which has become a prominent feature of one of Modi's policies of reform. So this is improving the well-being of the people of India, and we expect this to have an impact on the outlook for wealth creation within the country. This is an interesting illustration of the opportunity for the Indian consumer. The average income in India is approximately $2,500 per person. And as that increases, we will expect to see consumer behaviour change, and there will be increasing numbers of products and services bought by them. You can see with the graphic regarding beauty and personal care that India is one of the lowest ranking amongst its regional peers. And this simply illustrates that it has a long way to go to catch up as consumers earn more money and buy more basic goods and services. Hopefully, our viewers will be familiar with this positive expectation that we have for India. But Rob, do you consider that the valuations continue to be attractive?
Yeah, I think this first slide shows the China index over the last 10 years or so, and you can see the effect of the bear market we've had in the last couple of years. And the green line is the PE, which clearly shows that it's very much at the bottom of the range, and I think that's pretty well understood. I think the bigger question investors have is on India, which is this chart, and that is a much more complicated question. Clearly, the Indian market has done much better over the past decade, but the green line in the middle is the PE of the broad market, and as you can see, it's pretty much well in the middle of the range that it's been for that last 10 years or so. Now, at 20 times earnings, maybe that's high, who knows? But you could have said that in 2017. At that point, the Nifty was at 10,000. Today, it's at 20,000, and it's at the same PE. So you would have missed out on that. So our view is pretty straightforward: is that India is in the middle of its valuation range, not cheap, not expensive. And given the opportunities that John's talked about, I think that's still very attractive for us. But that's perhaps enough about the two major markets in emerging markets. But what about other opportunities, John?
That's an important question, Rob. And Mexico has been a beneficiary of investor interest within the emerging market space this year. This is an interesting chart because on the right-hand side, we can see the increase in gross fixed investment, which has been driven by the extent of international companies building capacity in Mexico with the intention of exporting to the US. But also on the left, perhaps less appreciated, has been the development of the growth in pension fund assets within Mexico. And clearly, as that figure has increased, a lot of domestic managers are investing in the domestic stock market itself. So it's been very supportive for better quality businesses, which are the types of companies that we identify. I would also highlight Indonesia has been a beneficiary this year of the move of production capacity from China in particular, as many companies have looked to have production capacity outside of China, and that continues to support the outlook for the domestic infrastructure and economic growth. And lastly, Brazil is worth highlighting, given they were one of the first countries to see an increase in interest rates to tackle inflation. Inflation is now declining, and we expect to see rates to fall further next year, and we think that will be a positive for the consumer behaviour. Given that improving expectation for inflation and a reduction in interest rates, what would be your thoughts for the outlook for 24, Rob?
So looking towards 2024, we have a couple of really positive drivers for emerging markets. Firstly, as we've discussed, inflation peaking and lower interest rates is very positive for both business investment and consumer spending. The nearshoring trend that we've highlighted sees investment growth very strong in a number of markets, excluding China, of course, in this case. The risk out there is there are a lot of elections coming up in 2024, with the most important probably in India in May. But for geopolitical considerations, Taiwan in January is also quite important. We have elections in Indonesia and Mexico as well to monitor. Valuations we've talked about, very much reasonable in the middle of the range in India and lower than range in most other markets, particularly places like China. In summary, clearly we've demonstrated the Aubrey Gem portfolio has very strong long-term track record, and we're encouraged by the short-term track record, which has improved dramatically over the year. Lower inflation and lower interest rates is positive for consumers as their real incomes improve. Lower interest rates and lower inflation are also positive for the valuations of our growth stocks that we focus in. The Aubrey Gem selective approach to quality growth consumer companies is very well suited to this environment, and we're optimistic about the outlook for 2024. Thank you.